Hello and welcome to our special Indianomics Inside China. In the past few weeks, China's internal politics as well as the global geopolitics with respect to China has undergone a sea change. Internals first. The recent Communist Party Congress cemented Xi Jinping as the head of the party for a third term, making him the most powerful leader of China since Mao Zedong. The Politburo has been packed with Xi Jinping loyalists only. Speaking of Mao, there is also a stated return to state-driven economic development and away from private sector and markets. Xi's emphasis is on common prosperity, and that indicates that markets and the private sector, with their alleged resultant meritocracy and inequalities, will be suppressed in favor of state-directed development. Meanwhile, the tirade against China that started from the Trump era has escalated into a near war, with the Biden administration banning the export of chips needed for advanced computing and even disallowing global companies exporting to China from even employing American citizens. A third factor that ties both these internal and external factors is China's growth story. The latest GDP print, coming in at 3.9%, affirms a fear that the world's second largest economy may slow to low single digits, thanks to many factors, from the no-COVID policy to geopolitics to aging demographics. All these raise a lot of questions. What may be the impact of Xi Jinping's rise as the new undisputed leader on China's economy? What are the implications of the new semiconductor war between US and China? 3, has the Chinese growth slowed for good? And what is the implication of that for the world? To answer these and related issues, I have with me one of the best-known China economists, Professor Eswar Prasad. This economics professor from Cornell is a former head of IMF's China division and author of a book on China, The Rise of the Renminbi. Professor Prasad, thank you very much indeed for joining me, and thank you for getting up so early to be able to be available to an Indian audience. The first question is really with respect to the rise of Xi Jinping and as him getting a third term and kind of packing the Politburo with his men. What are the economic implications of this undisputed nature of his rise?
So Lata, thanks for having me on your program, and you laid out the issues quite nicely in terms of what the latest party congress means for the structure of China's politics as well as economics. As you've correctly noted, one thing that has become very clear is that the top levels of the government in China, it is loyalism to Xi that has taken precedence over other factors. But there are even more important appointments that are coming at the technocratic level that we haven't fully seen yet. For instance, the head of the People's Bank of China, the Chinese central bank, who's a very competent technocrat, is likely to be replaced by someone who sees the world much along Xi Jinping's lines. So many of these executive agencies which are going to actually implement the government's policies are also taking a tilt away from market-oriented economics towards the notion of Xi Jinping's vision, which is that of a state-dominated economy. So I think we're going to see much more closing in, China becoming a lot more insular in terms of its policies. And Xi Jinping already gave us an intimation of that with the sort of frameworks that he's been putting out. Talk about dual circulation, for instance, which means that China is going to become much more internally self-reliant, but will continue to engage with the rest of the world, with one important clarification that engagement will happen on China's own terms rather than the terms that it sees being set by Western power. So I see a period ahead of consolidation of the state-oriented economic system, as well as some degree of disengagement with the rest of the world.
Okay. Well, to be fair, actually, there seems to be an industrial policy 2.0 in all countries. You know, US also, you see the US government participating in the making of semiconductor and fabrication industries. You see it in India. the rise of the state or the re-emergence of the state. But Professor Prasad, what does this mean in terms of private sector's attitude to China, foreign private sector? Will there be practically no fresh investments of foreigners in China because they fear that the state can be arbitrary?
Now, China is still going to be a decent growth story. Certainly, it's not going to grow by the sort of rates we've seen in the past 2 or 3 decades, at least until about 2 or 3 years ago. But China is still a very large economy, and when an economy of this size grows in real terms at 3 to 4%, that's still adding to a lot of global demand. The difficulty for private investors is figuring out how to make money off the China growth story, and that's a lot harder. Because you have to be very careful in terms of what sectors you invest in, and within each sector, what firms you invest in. And as you pointed out, the overall environment for private enterprise has become much more hostile. And this is a bit of a paradox here, because what China has been trying to do is move up the value-added chain. And if they want to generate better growth in the face of weakening demographics, large financial system stresses, and so on, they need the private sector in order to innovate, to create employment growth, in order to create productivity growth. But what we've seen very clearly from Xi Jinping's administration, even the previous one, is the desire to keep the private sector contained. In other words, there will be a subservient private sector that does continue to generate some degree of employment and productivity growth, but it has to be kept within bounds. And anytime an enterprise looks like it's becoming economically or politically powerful in a way that the Communist Party sees as a challenge, it is immediately squashed. We saw this happening with the Ant Group financial conglomerate, but there are many other examples as well. So there is this very difficult balancing act that the Chinese government is trying to put on, trying to use the private sector to achieve its objectives, while at the same time trying to maintain very tight control over the private sector. And whether these two elements can be managed effectively remains to be seen, but it certainly means a lot of volatility in terms of stock prices, and it makes it much harder to make the right sort of investments in China.
Time permitting, I'll come back to how foreign investors, both FDI and portfolio investors, will approach or ought to approach the new China. Let me get the geopolitics angle in first. How serious are these import restrictions of advanced semiconductor chips? Will they seriously maim China?
This is serious. For China, one of the problems is that this attempt to move up the value-added chain to higher technology industries is not something that can be done on the basis of domestic technology. Now, the Chinese government is pouring an enormous amount of resources into technological upgrading and trying to create platforms for domestic innovation. And I have little doubt that they will eventually get there, because they do have very skilled workers at the top echelons of the workforce, some academics who can certainly create new innovations, lots of entrepreneurs who still have the ability to take these innovations and run with them. So even in this hostile environment, it's going to be feasible, but they also have to fix the financial system to get resources going in the right direction. But all of this will take time, and China's reliance on technology from the rest of the world is certainly at a very high level at this stage. So it's going to substantially slow China's transition to a high technology economy, and in the short run could have a pretty disruptive effect on China's role in global supply chains if these import restrictions do start to bite. So I think the escalation of tensions between the US and China has now taken on a very different hue. When Trump put on tariffs on Chinese imports into the US, that did not have much of an effect. But these sorts of restrictions, which undercut China's own ability to produce certain types of goods or play an important part in the supply chain, those are really going to have a significant effect.
Do you see reprisals? It appeared that China brandishing that the use of force in Taiwan can't be ruled out is a reprisal. Are you expecting anything hot, actually, with respect to Taiwan or anything else?
So I'm an economist, Latas, and the political configuration in the South China Sea is certainly very complicated. So I don't have any predictions to offer on that. But what is very clear is that in the context of how China sees its role in the world, we are going to see a much more aggressive stance being taken by China in a variety of dimensions. Now that Xi Jinping has consolidated his power domestically, and especially in an environment of low and perhaps even lower growth than we are seeing in China right now, one way to maintain political support of the masses is certainly through an aggressive foreign policy stance. Whether that will take the form of actual hostilities or an escalation of tensions to the point where China can get its way on many issues, that remains to be seen.
Well, it certainly looks like, Cold War 2.0 with a different party to the left. But, I mean, that's what I was trying to figure. How do you look at economic relations with this geopolitical change? But I'll come to that in a bit. Let me get to the growth question now. The recent number of 3.9. Do you think that China is likely to deliver only low single digits in kind of the medium term as well?
Let's start with the short term. My view about China has always been that there is a lot of room with monetary and fiscal policies to stimulate growth in the short run. Because you can use monetary expansion, either cutting interest rates, flooding the system with liquidity, or use government expenditures. In some areas, China certainly needs more expenditures in order to stimulate short-term growth. But right now, I think the economy is faltering because there is a combination of the drag caused by the determination to stick with the zero COVID policy, a faltering property market, which is really important for the Chinese economy because it accounts for a significant share of GDP as well as household wealth. And on top of that, financial system stresses that are beginning to bubble over. On top of that, you have a very unfavorable external environment, and that is also making it harder for China to use, for instance, monetary policy very effectively because the Chinese renminbi or yuan has been depreciating very significantly relative to the US dollar. The US is hiking interest rates, so it makes it harder for China to cut interest rates, even though growth is slowing in China and even though China does not have the inflation problem that the rest of the world does. In the medium term, there are going to be very significant challenges. You've already alluded to the unfavorable demographics, but there are big financial system problems. We don't have much productivity growth, especially at the levels that China used to generate in the past. So China needs certain parts of the economy to function more effectively. The zero COVID policy, for instance, has put a crimp on private consumption growth. It's put a crimp on the services sector. And what China has been trying to do is rebalance growth away from a reliance on heavy investment towards consumption-driven growth. It's been trying to shift away from reliance on the manufacturing sector towards generating more services sector growth. So both of those objectives have been set back by the short-term problems, but it's going to have longer-term consequences as well. So ultimately, unless China can direct resources, financial, human, and so on, towards those parts of the economy that can generate better productivity growth, and unless it can accomplish this technological upgrading, it's very hard to see China being able to deliver growth even in the 4 to 5% range over the medium to long term, by which I mean the next 5 to 10 years.
What about the immediate term itself, since you spoke about the near term? While it cannot do much with monetary policy, given the way in which the Fed looks set to tighten and the dollar looks set to strengthen, the COVID policy is still very much, something that China can loosen or tighten as it wills. So, 3.9% in the quarter gone by. Can it do much better in the current quarter and even better next year?
Getting a good reading on China is actually quite difficult, and it's become more difficult because it's been harder to get into China for the last 2 or 3 years, of course. In the latest GDP data release, actually, there were some positive signs. So, for instance, fixed asset investment and the industrial sector have been doing reasonably well. It is the private sector, especially households, where we see much greater weakness. I think there is a lot of concern in the private sector, which has affected confidence. And because of the housing sector problems, which again comes from, at some level, good intentions, because the housing market is certainly something that needs to be normalized in China. It's become a hive of speculative activity. But in trying to fix that, you come up with other problems in the short run, and that is what China is facing. So realistically, the room to be able to move with policies is going to be limited in the short run. But having said that, they still do have some levers left. So for instance, local governments can continue to borrow and finance infrastructure spending. And in some parts of China, believe it or not, some infrastructure spending may actually be helpful. They are trying to spend a little more money in terms of the skill upgrading process that we discussed earlier. So they're not completely out of room for maneuver, but certainly that room has become much more constrained in the present domestic and external circumstances. So it's going to be a rough 3 or 4 quarters ahead for China, especially if they stick with the zero COVID policy, and they've shown no indication of either trying to modify or certainly not to reverse that policy.
Okay, Dr. Prasad, the immediate, question is for commodities, because China is both a producer and an exporter of commodities. As an economist, what do you think? Do you think that Chinese growth will bounce back and commodities could get some demand from China, or will that be actually a deflating force?
I think the best case scenario for China in the short run is probably to maintain growth where it is right now, somewhere in the 4 to 5% range. Again, there are levers like getting rid of the zero COVID policy that could unshackle growth in the short run, but I don't see that happening. So given that, and given that China is still trying to shift towards an economy that is less reliant on investment and less reliant on heavy manufacturing, that could portend weaker demand for commodities, even if China can generate growth in the 4 to 5% range. One of the areas where China has been trying to move ahead of the rest of the world is in terms of transformation towards green technology. That too is in the long run, or perhaps even in the next few years, going to reduce China's demand for energy, energy imports for a particular rate of growth.
Okay.
So I don't think we're going to see the sort of ability of China to pull the world economy along with it, and in particular, to pull commodity prices up just based on its growth. I don't think China is going to subtract a great deal from commodity demand in the coming quarters, but it's not going to add a great deal either.
Okay, well, that could be a plus and a minus for India. Those questions, really, how would India be impacted? Is there a genuine or even greater China plus one quest in the world? Those questions to you. After a very short break, we are back in a jiffy, Professor. Welcome back to our special Inside China Indianomics. We have been discussing with the China expert, Professor Eswar Prasad, to get a 360-degree perspective on how the various events inside and outside China are likely to impact economic growth there. Professor Prasad, thank you very much for your patience and for waiting on. I wanted to know how the renminbi might move. Your book on the renminbi itself has become very famous. Do you think China will allow the renminbi to depreciate even more simply because it will give it an export advantage? What's your best guess? Does it go towards 8 towards the dollar, or does it go below 7 towards the dollar?
Now, China made a commitment a few years ago to allowing the renminbi's value to be set largely by market forces, and we are seeing a real test of that commitment. And so far, it does seem to have held up by and large. The renminbi has been depreciating quite significantly against the dollar, and like many other currencies, including the Indian rupee, the depreciation on a trade-weighted basis is much smaller because there are many other trading partners of China whose currencies have depreciated even more relative to the dollar. But the currency that matters in international finance, of course, is still the dollar. And for China, this is a concern. And right now, we are beginning to see less capital flowing in and some capital from domestic investors seeming to flow out. And that's partly because the stock market and the economy have not been doing well, but also it's very clear which way the political winds are blowing. So I suspect that there is some money from the elite classes, the economic and political elites, that may be leaving China in search of safer places. So for China, this is a slightly complicated moment because while some degree of renminbi depreciation might be useful in terms of supporting export growth, the amount of export demand in the rest of the world is actually quite limited at the moment, given that the rest of the world is facing a fairly difficult set of economic circumstances. Now, Chinese exports have not done too badly in the last 3 or 4 quarters, although we are beginning to see some weakening in terms of export growth. So China now faces this difficult situation where a depreciating renminbi doesn't give them a huge benefit in terms of additional export growth, but could set off instability in terms of capital flows, because if people anticipate more depreciation, that could lead to even more capital outflows, less capital coming in. So you set off a currency depreciation, capital outflow spiral. So I think we might see further depreciation on a very controlled basis, where China tests out the grounds, tries to see if a move of the renminbi in a weaker direction leads to more capital outflows, leads to more destabilizing effects. And if not, I think we might well see some additional depreciation. So far, we haven't seen any capital control measures to limit the amount of money going out of the economy, although they have started putting some restrictions on banks' ability to borrow abroad in foreign currencies and so on. And I suspect they will rely on that tool as they have in the past if the pressures on the renminbi become more severe.
I'm tempted to ask you about the Fed tightening as well, but I don't think I have that much time. Let me stick to the China issue. What does all this mean for India, Professor Prasad? The fact that there is an escalation of tension between US and China, the fact that China itself, political economy-wise, is becoming a bit suspect or a dangerous game for foreigners, does that make India more attractive?
Yeah, so let me stick with the economic aspects of that question, Lata. It's clear that there is an opportunity here for India in terms of becoming an important part of global supply chains, and in terms of becoming a supplier of certain products where China has tended to dominate the market so far. And I've been quite encouraged, to tell you the truth, to see that unlike in previous episodes where the rupee depreciated, but we didn't see much of an effect in terms of India's export growth, we are seeing Indian exports doing somewhat better than they used to in the past episodes of rupee depreciation. And more importantly, we are seeing some high technology exports beginning to pick up. So they're not at a level yet where they would make a huge impact on India's growth. But I think this can be the foundation for India becoming a much more important part of global supply chains, and moving up the value added chain, moving into higher technology sectors itself. I also see India as becoming a potentially more interesting, attractive destination for foreign investors, because we do have fairly deep, liquid, and well-regulated financial markets, and especially compared to a market like China, where clearly there is going to be much more volatility down the road. There is a lot more uncertainty about government policies. I think this is the time when India, if it can show that it has stability in terms of economic policies, and in terms of the overall policy framework, as it becomes more conducive to the private sector investors, to private enterprise more broadly, we could pull in a lot more investment in terms of both foreign direct investment and portfolio investment.
A last quick question. I'm not being allowed by my producer, but I am going to take the liberty. We get two different reactions. There are one set of foreigners who say, or especially Americans, who say that China is a dirty word and we won't be allowed to invest there anymore. And therefore, we will look for other destinations, India attractive. And the other set which says that, China is so important that what we will invest outside will be a very small percentage of what's already tied to China. Which is the truth?
So there is going to be some passive money that goes into China still. It's still a part of important equity and bond indexes. There is going to be some money made in China still through very selective investment strategies. But it's going to be terrain that is attractive to investors who are looking for decent yields, but with very high risk, both economic, political, and of course the geopolitical risk aspects as well. So I don't think we will see that much active money going into China, and we're looking for other destinations, especially because in the coming years, we are going to see economic policies in China take a turn. that is going to be much more, as we discussed, state-dominated, and that is going to make it harder for private enterprises to thrive. It's not that we will see a huge pullback of money from China, but certainly this is going to make investors take a very close second look at any investments they make in China, and possibly cause them to pull back and look at other markets.
All that is sounding like Advantage India. Thank you very much, Professor Prasad, for giving us additional understanding of the myriad changes that are happening inside China and with respect to China. Thank you very much for joining us on this edition of Indianomics.